Hello there, everybody. I think it's time to get started, and we appreciate you being right on time today and for taking a part of your day to be here with us in the room. We're glad to have you here. This is Craig at Max Trading, and I'm excited about today's presentation. You are among the first traders to learn about the new upgraded edition of Max, and this makes it a really good time to learn more and to get involved and to get trained in a truly effective trading system. Actually, it was more than 4 years ago when Eusebio began working on some of the upgrades that are now available to you. He noticed the need for something reliable to help us deal with the way the markets have been changing, limited ranges and a lot of volatility. So Eusebio began to develop and to test and to work on what we now call the Max Enhanced Trade Format Indicator, or the ETF for short. This has been available to upper level members of the Max community for several years now and has proven itself many times over and over again as a very effective addition to our charts. And so now we have chosen to add ETF to every level of Max training. This means that no matter what course you select, you will also get the ETF indicator and the companion bias indicator, and will help you learn how to use these tools. So this can make a huge difference for you and really give you a great shot at becoming a successful trader. And by the way, we think it is equally important that you get an opportunity to see our trading methods in real-time price action on live charts. Perhaps you've already had that opportunity, but if not, we'll send you an invitation to attend our session coming up after the non-farm payroll news release. So we'll take advantage of whatever price action the market offers us on Friday. And if you haven't registered for that, I hope you'll register, just so if nothing else, you'll get the video of the live action for that trading session. And by the way, we'll be using the ETF indicator and the companion along with it during that session, so you also get to see that in action on the real-time charts. Eusebio is the developer of ETF, and that makes him a great choice to take us into the world of Max trading and give you an in-depth look at it. Eusebio is a phenomenal trader and a truly skilled teacher, and equally important, I think, maybe more important, he has a genuine enjoyment of helping his fellow traders, and you will sense that as you listen to him today. Eusebio is our instructor for all 7 class sessions of the ETF standard course, and also teaches the ETF primer course, and you're going to appreciate very much his attention to detail as he helps you learn these methods. So Eusebio, we do appreciate all that you do for us, and I'll turn the microphone over to you.
Thank you very much, Craig. Hello, everyone. Welcome to everybody in this presentation room. I also warmly welcome those who have registered. We have a lot of people having registered, but who will watch the video, and I can understand that because today we are still a very special day. We are the Monday of Easter, and in many countries it is a holiday. So I really appreciate and I'm grateful for your presence here. Before starting, let's make a quick audio and video check. Do you see my screen? And I'm displaying a PDF page, and do you hear me well? If you would like to type a yes or a Y in the question area, I would really appreciate. Oh, Robert, you have been first to on the spot. David, Roxanne, Case, a lot of yes. So thank you very much. I really appreciate. Omer, Gavin. I will not mention all of them. There are too many. So before starting presenting the Max, let me give you a very quick background of who I am. So as you have perhaps guessed, English is not my mother language. I am a Belgian trader living in France, so I have a very bad English, Globish as we name it. And I am in fact a former software engineer, having practiced that profession for around a little less than 30 years in the IT services industry as a services manager. And during the last 15 years of that career, I have had the great opportunity to work with important banks in Europe, and exclusively banks in Europe. And this has given me the possibility to be in contact, to meet and to discuss with several traders in bank. And so I have learned a lot from them. And but at the same time I was practicing my career in the IT services, I have developed also a passion for investing and trading more than my career itself. So 34 and more years experience in the stock market, in the options market, futures market, and since 2000 the Forex, trading in the Forex. So I have traded almost all the market except two markets, the commodities market and the bonds market. What I will present to do today to you is some of the concept of the MAX ETF trading system. I will illustrate them with some trades example, and I will talk about somewhat about the money management we have and what we can achieve with compounding the result we can get from the MAX. The MAX, in fact, has been created long years ago by late Dr. Jim Pruitt, known by his student as Tiger because he had a strong temperament. And when Jim was picking on you, we said at that moment, growled by the tiger. So it was an amazing experience. Not because Jim was a bad person. On the contrary, he was a very nice person, very generous. But he knew that his time was counted and he wanted to share his experience and knowledge with as many students as possible. So the aim of Jim was to give traders a very powerful, reliable and flexible trading method. And I like to use the term method instead of systems because it's not a method based on fixed, rigid rules. It must adapt to the market conditions. And this is why, in fact, over years, on two occasions, I have tried to improve the MAX, as Craig has mentioned, by introducing first of all the SAM concept and then 4 years ago the ETF concept. The MAX, as you will see, is based on very simple concept, but it's not so easy. They are not so easy to apply. There are a lot of details at several levels we have to take into account to succeed with trades. And for that, there are two keys which are fundamental to become successful with the MAX: work and commitment. Work because, as I have said, there are a lot of details to understand and to apply correctly. And commitment, of course, we trade because we would like to make more money. And but I can tell you that if making money is your only commitment, on the long term you will not succeed. Craig has mentioned some of the stronger or the strongest commitment you may have in order to become successful in trading. For example, improving your family life, helping your friends, helping your community, and so on. These are high-level commitment which will help you to sustain, in fact, the efforts which are necessary to handle, to learn, to assimilate and master and correctly apply a trading methodology like the MAX. But there are also other skills to develop: discipline, patience, persistence, concentration, confidence. Discipline and patience are obvious indeed, because the MAX is based on concept and rules. Each rule represents a set of conditions to be fulfilled in order to take a decision in the trading process. So we need to wait patiently that all the conditions are fulfilled, and then we can apply the rule, and strictly the rule. This is the patience and the discipline aspect of trading with the MAX. And persistence. Persistence is also something, a skill which is or underestimated by some traders. Many traders have a tendency to jump from one system to another, hoping to find a holy grail, perhaps. But they jump from one system to another because of a few losing trades in a row. unfortunately, losing streaks exist. And they are even larger than what many traders may think. For example, even if you have a trading system having a winning rate of 70 or 80% winning trade, so winning rate, you will face losing streaks made of 4 to 10 losing trades in a row. 4 to 10 losing trades in a row. And so you have to sustain these losing streaks. And sometimes the situation may be even worse because you may have clusters of losing streaks. And how to survive these losing streaks, because they will create a drawdown, of course. And so you need also to control the drawdown. And this is why persistence is important, and not jumping from one system to another after just a few number of losing trades, which are less than what we have to statistically observe. Concentration, I have said that we have a lot of details to take into account, and so when we trade, especially when we day trade with a small time frame, like the 5-minute time frame or the 15-minute time frame, we have to pay attention to every detail we see on the chart, but also to some details which happens outside the screen, which may influence the movement of the pairs we are trading, for example, the news release or some other event around the world which may influence the market. And confidence. Confidence must be developed. This is related to the psychological aspect of trading, in fact. But the confidence must be developed at several levels. First of all, the trader needs to develop the confidence in the market itself, in the ability of the market to propose day after day after day enough opportunities to trade. Confidence then in the max, in its ability to catch these opportunities, or most of them. It's impossible to catch every opportunity. So we can forget that. And we need to be extremely picky in the opportunities we may have to trade. An opportunity may seem good, but in fact may be a disastrous trade, in fact. And confidence in ourselves, in our ability to sustain the efforts to understand the max, to apply it correctly, and then to handle correctly the trades corresponding to the opportunities we may pick up every day in the market. And so when we talk about a trading system, it seems for me that it makes sense to define what is a trading method. What does it involve to trade with a trading method? And the first point for me is to define what are the movements we want to trade. How do we define a trend to trade? Once we have defined what a trend is, we have to define, of course, how a trend can start and when it can start. And so let me take my red spot here. It will be easier for me to show along my PDF. So it's important, once we have defined what a trend is, to define when and how a trend can start. We never know when a trend starts, how far it can go. It can be a very small movement, it can be a very huge movement. But at least we have to pinpoint when it can start through what we will call setups. And a setup is simply a set of technical conditions. Once we have such a setup, the setup must be validated before considering taking the corresponding trade. And we consider that the validation must be made under 3 types of conditions. The technical validation, of course, the setup must have the correct pattern. Then we have to validate the setup for the risk the trade will involve, should we take the trade. And we have to consider also the global context. The global context must be in agreement, or the trade must be in agreement with the global context. The global context are all the elements which may influence the market. And we can say by simplification that there are three types of elements in the global context which may influence the market. For example, all the decisions day after day of the central banks. This is related to their monetary policy. There are a lot of things we may consider about that, not only the interest rates, but also the news release, or more generally the macroeconomic factors influencing the market, and the geopolitical events which may influence the relationship between different countries. So all these aspects are not so easy to understand, to analyze. Some of them are easier. Of course, geopolitical, for example, may be very complex. But for me, this is the most important aspect. If we have a valid setup, if we have an appropriate risk, but if the trade does not correspond or is not in agreement with the global context, we simply skip the trades. Then once we are in a trade, we have to know how to handle the trade in order, and this will be always the first priority of a max trader, in order to reduce the risk involved in that trade, or possibly to cancel the trade in such a way that cancel the risk, in such a way the trade becomes a risk-free trade. And then when we are in a risk-free situation, then we can consider how to optimize the profit we can extract with that trade from that trend. And then, of course, we have to know when to close the trade by knowing how a trend, or we will call them directional movements, in fact also, so when a directional movement can possibly exhaust. And I say can possibly exhaust because we can never be 100% sure that a movement will exhaust or even will reverse. An exhaustion does not necessarily mean a reversal. It may be simply a pause, the price will range, and later the price will resume the same directional movement. Or it may perhaps reverse. So then once we have that set, so we can define what the max is. And so historically, and I will call that historical max the classical max, the max is in fact an acronym for three concepts, which are still, of course, valid with the max ETF. So the M stands for momentum. We need, in fact, indeed, to see enough momentum in the price movement, but also enough volatility before considering a potential trade. The A of max stands for acceleration. Once we are in a trade and along the trend, as long as the trend is valid and under very specific conditions related to the trade risk management, we progressively add to the trade in order to build a larger position while controlling the risk on that position in order to extract more profit from the same trend. And then the X stands for exit. We need to know when to exit from that trade, either partially or totally. And along a trade, we may have, depending on the level of the max, several partial exits. I will illustrate that in some example in a moment. And so basically, the max is a trend following method. In the classic max, we defined also what is a trend, what is a counter trend, and so we have several levels of the max. So in fact, 5 levels of the max, as I will show in a moment or later in my presentation. We have the max primer, the max light, the max standard, the advanced, and the sum. So we consider in the classical max only trading counter trend movement and consolidation movement only starting with the advanced level. This is no longer true with the max ETF. With the max ETF, we have generalized the concept of trends, and now a counter trend movement can be a portion of an entire max ETF trend, as I will show again in a moment. And with the rules we have to trade a movement, we have also a very strict trade risk management rules and money management rules. And I like to make the distinction because the trade risk management is related to the way how we handle a trade, how we progressively reduce the risk on a specific trade, and the money management has the aim to grow or to manage the trading account. How do we handle a drawdown? How do we increase the trading account while we are in a favorable situation when trading? And so considering all these elements, so the max can be applied in fact to every time frame and to any tradable market. We have max traders trading in the 1 minute time frame up to the daily and even weekly time frame in the Forex, in the currencies market, so in the futures market. Some trades also stocks, indices, for example, and even some commodities, for example. So understanding what the max is of course important, but it is also important to understand what the max is not, in order not to create false expectations about what the max may be. So the max is not a scalping method. We do not try to catch just a few number of pips in the smallest period of time. We are trend followers, trend traders, in fact. It is not a news trading method. We do not try to catch these nice spikes the price is sometimes doing when we have a big surprise in an important news release. However, the movement after that spike, after the news release, in the case we have a big surprise, becomes tradable under specific conditions related to the way the news has been released. And it is not, as I have said, an elementary buy and sell system. We don't have fixed, rigid rules. Our trading rules adapt to the market conditions. We have several types of market conditions. We call them the price modes. We have, for example, a trend mode, we have a counter trend mode, we have a consolidation zone mode, for which we have to make the distinction between a tight consolidation zone mode and a large one. We have the choppy mode, and we have what we call a very special case, a spaghetti mode, during which we have never trades opportunities, for example. So it is important also to know when not trading. And so in fact, the way we see our rules is the following. So we have basically the entry setups and the exit setups. The entry setups defines, in fact, potential opportunities corresponding to possible trades. And before taking a trade, we have, as I have said a moment ago, to validate the setup under three types of conditions. I will not repeat these three types, you see that on the PDF. And then the exit setups are defined, in fact, not as conditions trying to predict what the price can do, what the price, or how the price can possibly reverse, but as risky situations. At some point, for example, when the price begins to retrace, or to go against the trade, a pullback is not necessarily a risky situation. However, if the pullback lasts too much, if the pullback becomes a deeper pullback, then this can represent a risk for the trade. And so once the risk becomes real or big enough, we need to take decisions in order to reduce that risk. And so we have several types of exit setups. We have exit setup based on technical indicators. We have exit setup based on pure price action. We have what we call hybrid exit setups based on a combination of the price action and one indicator, for example, a Bollinger Band. We have exit setup corresponding to timing aspect, and we have trading exit setup corresponding to what we call movement in validation, and I should add also exit setup corresponding to a trend reversal. If we are, for example, in an uptrend, and we are exploiting that uptrend with a long trade, and suddenly we pinpoint a potential trend reversal, and if we get an entry setup to go short, we have to close, of course, the previous long trade before opening the new short trade. So we have several types of exit techniques in order to be as accurate as possible in our exit techniques. So now, Craig has mentioned that a few years ago, so in fact 4 years ago, I have considered the necessity to improve the max because the market was changing conditions. In fact, you all remember in 2008, 9, 10, after the subprime crisis, we have seen important momentum and volatility in the market. Every day, many pairs were doing exceptional trades, exceptional movements, so trends. And so exceptional trades, I remember in 2008, 2009, it was easy to trade because of these important movements. So, but I am, as I have said, a guy with a strong mathematical and physics background as a software engineer, and I told myself, okay, we are seeing extreme conditions in the market, and because the human beings are always going to the extreme, from one extreme to another, I would not be surprised to see these momentum and volatility situations going on the other extreme with small momentum and possibly small volatility. And so if this is the case, we will have some challenges to overcome with our trend following system. And these challenges are typically the following ones. We may have at some point poor price action or small price movement. How do we handle a small price movement, so a small trend? If the price doesn't make a movement large enough with a trend following system, it becomes really difficult to make some profits. We may have sometimes, due to the entry setups we may sometimes miss an ample movement. This is the case, for example, when the price reverses very quickly. And because we use some indicators to help us pinpointing faster some opportunities, when the price moves too fast, the indicators we are using, for example, a moving average, does not react so fast. And so we may have a lack also of reactivity in some of the tools we are using. And with the classical max, I have always felt a bit frustrated by the fact that we have to make the distinction between a trend and a counter trend. I will explain in a moment what a trend and a counter trend is based on the classic max. And sometimes, whatever the time frame we are trading, even in the 5-minute time frame, for example, because we are using time bar charts, and this is the case with, again, with also 75% of traders all around the world approximately, inside a bar, the price can make a lot of movement, and so if we limit our chart to time bar chart, we can lose a lot of details in the movement the price is doing before printing the close of the bar. And so we may miss some opportunities in such a case. And so these are, in fact, the challenges the MAX ETF tries to solve. Just to illustrate the loss of momentum and volatility, but especially momentum we have seen over years, this is an example on how the average daily range of some pairs, in this case the euro US dollar and the pound US dollar, have evolved during the last 8 years. And we can see that from time to time the average daily range can drop, and can drop even dramatically. And nowadays we are really in small average daily range. It is the case also for a pair like the pound US dollar, for example. We can see that sometimes they can be at a very high level, and then they progressively drop to small levels before there are other reasons for the market to recreate momentum and volatility. I have shown the example of two major pairs, but it is also the case for other crosses. For example, here we have the euro kiwi and the pound yen, and we can see how over time the average daily range, which contains the momentum and the volatility, can drop dramatically. It's clear that if we are now at that level, the daily range is way smaller than when we were on that level, for example. And so we have smaller trends, in fact, and we have to deal with it. We have to adapt with that. And so so this is why the ETF concept has been developed and introduced into the MAX, in all levels of the MAX, and we are proposing to you today, as I will illustrate in a moment, 2 levels of the MAX Primer and the MAX Standard. So that ETF concept has the aim to trade many more movements, and first of all to generalize the concept of trends, recombining what may possibly be a classic trend and counter-trend movement. And so if we are able to consider such kind of recombination, we can trade also larger movement. So, and let me show you some example of what I'm explaining. On this chart, we have some of the tools we are using. We can see, for example, some moving averages. We have especially this long-term moving average, which correspond to what we call in our jargon the home base. It's a 233 exponential moving average, and we have smaller one. And in the classic max, a trend is a movement on one side of that home base. When the price is below the home base, we look for downtrend and we look for short trades. When the price evolves above the home base, we look for uptrend and we look for long trade. And so, for example, this movement here, which was in a downtrend, is called a counter trend movement because the price is going against the trend, going toward the home base. And if the price succeeds to cross up the home base, it will develop a new uptrend. And so typically in the classical max, such a counter trend movement is not tradable except if we consider advanced concept of the max advanced. But with the ETF now, this kind of movement is tradable, as I'm going to show in such example on the next slide. And we have also some other tools. For example, here we have a momentum oscillator, which is the stochastic of the RSI. We like it to help us pinpoint some kinds of our exit setups. And then the ETF concept itself is based on two tools. We have, first of all, these yellow and orange line on the chart. And we have what we call the companion indicator, which is the bias directional indicator made of two lines I will explain. You can observe that these ETF lines react faster than any of our moving averages on the chart. And they are extremely regular. Look on this down movement. On this down movement, we have, for example, here we have a pullback, we have another pullback here, we have a small pullback here, we have a deeper pullback here, we have a small one here, and then a deeper pullback before the trend reversal. And look how many times along that down movement, the ETF lines have been influenced by the pullback only here on this place, and only here when the price is reversing its trend. And so it's extremely regular, extremely linear, and this gives a great advantage, in fact, to the trend follower traders. So we have also that companion indicator, as I have mentioned, which is made of two lines. The line in green and red is what we call the slow bias, and this slow bias will give us, in fact, what we call the ETF trends, so the movement we have to trade. When the line goes from green to red, we will look for short trades, and when it will go from red to green, we will look for long trades. And so the combination of the ETF lines and the slow bias will give us trades opportunities. And we will use also the second line in blue and brown to fine-tune the recognition of the beginning of a new trend. For example, in this example, we have a potential trend reversal starting from this area. And so from this area, we can begin to look for long trades along all that movement up to that point here when the price makes an attempt to reverse on the other side. And so on this chart, I illustrate in white notations the different decisions we could have made on this movement with the classical max primer. And you can see that here we have an entry setup. An entry setup is a set of conditions when we can technical condition when we can possibly open a trade. It is called, in this case, a safe and perfect mode. We have with that entry setup a stop loss, we have rules how to place the stop loss, and we have rules telling us how to calculate the size of the trade. But we always consider a trade is made of 2 units. For example, if the trade size is, let's say, one standard lot, 1 unit is 5 millilot, yes. In such a way that at some point along the trade, exactly on this point where you see that small horizontal line, we have a setup, an exit setup, and we'll call it an MX. An MX means momentum exit, and if the price fulfills that condition, we close 1 unit, we close half of the trade. In this example, closing that unit has got a very small profit, 4 pips. And later on, we have on this point here another set of conditions for our exit. We close the second unit, and closing the second unit corresponds to close the entire trade, because the trade was made of only 2 units. And so a final close of the trade is called an XXX. And in this case, the second unit has got 18 pips profit, representing a total of 22 pips. And because the stop loss size was 60 pips, the realized reward to risk ratio is a tiny one, plus 0.18 R. We use the Von Tarp notation. R represents the risk. For example, if the risk on the trade, the financial risk, was 2% of your trading account, this means that that trade has generated a profit of 0.18 times 2% or 0.36 so 1/3 of 1%. Now with the max ETF primer, because we consider differently what a trend is, we define the concept of ETF trends with that companion indicator, we are able to catch the down movement, the reversal on this point with what we call an ETF safe and perfect mode. And we have similarly an exit setup here. We close one unit and later on we close on this same spot here the second unit. But you can see that the result of each unit is different. We have now 36 and 61 pips for a larger reward to risk ratio, 97 pips for a 2.2 reward to risk ratio. But later on, and this is much more important, we had the opportunity to open a second trade here, which corresponds to a trend resumption. It is called a remo. And with the same mechanism, we can close one unit on this spot and then the second unit on this spot, catching in the first unit a small loss. This happened, of course, and a nice profit on the second one for a total of around 3/4 of 1 hour for the second trade. And you can see the difference between the two results simply because we define differently what a trend is. You can see also different vertical lines. The orange ones correspond to open and close of the session. We have the Frankfurt Open, the London Open, the US Open, the Wall Street Open, the Frankfurt Close, the London Close, and so on and so on. And you see also here a red vertical line corresponding to an important news release. In this case, it was the Euro M3 money supply year over year. This news create rarely a big surprise, but when there is a big surprise, the movements are huge. And in fact, it happened that there was no surprise in this example. But you can also observe that the entry has been made after the news release, not before, after the news release. You can see also on the chart this horizontal line. We call that line max price level. We may have several of them on the chart. We produce them every weekend. And so this was a trade made on the 27th of March. That level has been defined on the preceding weekend. And you can see that the entry setup is on the right side of that max price level. Should the trade be a long trade, this trade would have been a questionable trade because the potential movement would not have been large enough to consider a profitable trade. So this is a kind of the risk aspect we have to take into account when we consider taking a trade. Now this is the max ETF primer. So two simple trades, each trade having one entry, one MX, one XXX. And we can make several trades along the same trend. Now with the max ETF standard, this is something else. With the max ETF standard, first of all, let's make the comparison with the classic max. With the classic max, we look only for short trade below the home base. And so we have here one trade starting at the same spot, of course, with the safe and perfect mode. But then you can see on the white notation, it's perhaps difficult to see, but we have one MX here, then one scale-in with that small white angled line. A scale-in consists in adding 2 units to the trade. And then we have another MX here, then another MX here, and then the XXX here. So we have one entry, 2 entries, and we have 1, 2, 3, 4 exit, closing 1 unit at each exit. And you can see the result of that trade. So it was not a big profit because the movement was not a big one. With the ETF standard, because we are able to open the trade way early, and you see all the decisions in yellow, we are able to make more scale-ins. We have in fact 4 scale-ins, 7 or 8 MX, and 1 XXX closing 2 units. An XXX consists in closing all the open units. And you can see that in this case, because we have been able to add 1, 2, 3, 4 scale-ins to our initial entry while controlling the risk, because this is very essential. We do not make a scale-in randomly. We have precise rules to do that. The result is completely different. The result of that short trade is shown here, 188 pips for a nice realized reward to risk ratio of 4.27 hours. This means with a 2 risk percent, a profit of 8.5 1.5%. Even with the 1% risk, you still make a nice 4.2% profit. But now the great advantage of the ETF, of the max ETF, is that we are able also to catch that trend, counter trend movement. And so with that, because now it becomes in fact an ETF trend, an upward trend, thanks to our companion indicator, and it was possible also to make one scale-in. And you see the kind of trade, an entry here with its stop loss, of course, a scale-in, an MX, an MX, an MX, and the final exit with 1 unit, giving an additional 1.15R. So that day, with that movement during the European session after the news release, so 2 trades with the max ETF standard for a nice 5.4R profit. And we can compare this profit with the ETF primer. This was the first example. A second example is this one. I will not go through the details. So we may have, depending on the length of the movement, several trades with the max price. For example, in this case, we had 2 short trade, 1 long trade for a total reward to risk ratio of 4.88R. What is amazing in this example is, despite that nice down movement, with the classic max primer, it was impossible to trade that down movement. And you can see also we had a max price level here, how the price has reacted on that level, helping us to take also that long trade in a very safe way. And again, observe the trade has been made after that news release. And with the ETF standard, of course, with the scaling technique, we have the same movement, the same, not necessarily the same entry, we may have an earlier entry. But you can see the different steps of scaling in and scaling out from that trade until we have the reversal on this point, which corresponds also to a new long trade. Now you can see the difference of the result in the realized reward to risk ratio. So when we get a large movement, we call such kind of movement a true trend, and this true trend happens on average 2 or 3 times per week per pair. We have 5 trading days per week, okay, and we have 2 or 3 days on average, giving an ample movement. And for the remaining days, we will have smaller movement or not good opportunities to trade. But when we get such movement, we get nice trading result, and you can compare that number with those provided by the max primer. So we importantly increase the profitability of the trade. The example I have shown in the max, in the previous example, are on the 5-minute timer. This is another one. I will go quickly through these examples. So the structure of the trades are always the same. They were in the 5-minute timer, but we can trade also in another time frame. For example, in any time frame. And in this case, I have considered the daily time frame, and it was the pound Aussie. And with the classic max, it was only possible to consider that portion of the trend, so a long trade above the home base, giving, as you can see, a small profit. No trade with the max primer, only one with the classic max standard, so with a small reward to risk ratio, because the movement was a small one. And this is the kind of situation for me which have been in the past frustrating, okay? Combining in that entire movement a counter trend portion and a trend portion. And now these are situations we can handle with the ETF that way, okay? And you can see the difference of result with the max primer and the max standard. So we have an important increase of the result because simply we are seeing the movement in a different way. And then it was possible to switch to a downtrend and a short trade in that nice down movement, okay? Well, Simon, we do not explain the strategy here. The strategy is explained in the max courses, okay? And we propose to you today to consider taking our max ETF primer course and the max ETF standard course. And Craig, in a moment, will give you the conditions for these courses. Okay, I'm simply illustrating so some of the concept and some of the the result we can obtain with the max. Okay, it is not a training session here. What is important to understand also is we don't have a 100% winning rate. Of course, we have a 70-75% winning rate, and this means that we have not necessarily 25 to 30% losing trade. We have also break-even trade. But when we have a losing trade, what is important, in fact, to understand here is a losing trade is always a small loss. In this case, this is a typical example of a losing trade. We open a trade, in this case it was a short trade, and immediately after the price reverses, goes against the trade, and we have a first exit and then a second exit on this point, creating a losing trade with a loss of 22 pips, for example, and the realized reward to risk ratio, which was negative, was not minus 46R, but there was a typo, minus 0.46R, so a little less than half R. And this is on average the size of our losses when we have losing trades, so minus half R. If you have a risk of 1%, for example, your average loss will be minus half a percent. Okay? Well, I have mentioned that we have also choppy conditions. This is an example of what a choppy market is. The price moves with or without any directional bias in a very erratic way. We have rules to recognize what a choppy market is, and when we are in such a choppy market, if we are able to recognize it, we will have almost never good trades to consider. And when we have a valid trade to consider, then they are few, first of all. But then if we want to trade them, because we have always the possibility to skip that trade, we will have, if we want to trade it in a special way, in a very careful way, in order to optimize the possibility to still make a profit from that trade. So in terms of compounding, in fact, we are facing two types of situations when trading. We are facing normal or favorable situations, and we are facing sometimes bad market conditions due to what is happening in the different economies, or what is happening on the geopolitical levels. When we are facing normal or favorable conditions, we can compound our profit. And even if we try to catch only a small reward to risk ratio, we can still get an important growth of the trading account. Let me show you an example on a PDF here. This PDF helps to make some projection, and I think you will get that PDF as a gift for your presence today. Let's consider, for example, we trade every day. Okay, and let's consider we start with a trading account of $10,000 using a risk of 2% per trade. We need to make some assumptions on the trade. If we want to make some projection for the future, what we can possibly obtain in our trading process, we have to make some assumptions, two assumptions. First of all, I will consider an average stop loss size. For example, I have taken a very conservative 30 pip size for the stop loss here. And let's suppose we are able to realize with one or several trades along the day, a 1-to-1 reward to risk ratio. So 60 pips here. Don't forget we use 2 units per trade. So whenever we use multiple units per trade, we have to divide the total number of pips made by each unit by the total number of units. So 60 pips divided by 2 is 30 pips, and 30 pips divided by the size of the stop loss is 1-to-1. Okay? You see the percentage here, so 2%, a 1-to-1 with a risk of 2% represent a 2% profit. And the objective is, for example, to double the trading account. If we are able to realize that reward to risk ratio every day, and if we trade every day, we need only 2 months to double the account. You see here $20,000 instead of 10,000. Of course, this is easier said than done. Why? Because it's not obvious you will trade every day. Of course, another problem is, it's not a problem, it's the reality. Some days you will make a larger profit, but some days you will make a smaller profit, and some days you will make a loss. And so, considering all these differences from an ideal situation, it will take you more times to achieve your objective. But if you are consistent in your trading process, this gives you a raw idea of the time necessary to double your account. And I have not considered a withdrawal here in this example. We can consider a withdrawal, and let's consider even a little more ambitious result when we apply, for example, the max ETF standard level. We can consider a higher realized rework to risk ratio, and I have been very conservative here, 100 pips per day with one or several trades. This represents a rework to risk ratio of 1.6, 1.7 to 1, or 1.7 R. And if we are able to do that every day, and now I consider making a withdrawal of 5% of the account every month, 5% of the account, not of the profit, of the account. You see the withdrawal we can make every month, and this will increase month after month. This is the remaining capital after the withdrawal, and we can see that we can still double the account very quickly and even multiple the account by 10 in around 4 months, by 10 in around 4 months. If you are consistent enough in the process, helping you to catch a higher average reward to risk ratio. And this is very important. The consistency is not in the fact that you are able to generate regular profits, because you never know in advance the result of one trade, but in the way to apply the trading process. And if you get consistency in the trading process, you will get the result. By the way, with the ETF the primer, the max ETF primer, the average rework to risk ratio per trade is between 1/2 and 1 R. And with the ETF standard, it's around 3 hours, and sometimes way, way larger. But on average, we can count on 3 hours. And when we are in a less favorable condition, we have to uncompound. So the trade size will depend also on the trading account, using the important concept of the position sizing concept. So as I have said, and before giving the mic to Craig, in order for him to give you some more general information about what the max is. So the max courses are organized in 5 levels, in 5 different courses. The max ETF primer course, this is one of the courses we propose to you today, is a very basic level of the max, with very few entry setup, very few exit setups, but still profitable, so, and consistent. And we propose you that first level of the max in order to help you make an idea of what the max may be and who we are. Are we serious in the trading activity? And so this course, which is made very intensive, however, but at a very low price, will help you to make your decision if the max is worthwhile for you. Then we have the max standard course. The max standard course contains all the concepts we have with the max, the scaling technique, the trade risk management, so every element. And so this is our flagship course, and we have also an intermediary level which is called the Max Light course, which is available, for example, for free once you have made the standard course. It's a kind of refresher. And then we have 2 higher level I will not describe here. With the Max ETF SAM, we go deeper into the details of the price movement in order to catch many more opportunities the price can develop while unfolding its movement. And with the advanced courses, we consider more global facets of trading, like the relationship between several markets, like the relationship between the price movement and some types of correlation, not the correlation of pair, but the correlation between currencies themselves. We go deeper into the trade risk management. We go into a very important aspect I call the discretionary situations, how we can be more flexible with some rules and under which conditions, because it's out of question to introduce subjectivity, of course, and we go deeper into the way to exploit the news release. It's amazing what we can extract from the news release. And so I will end my presentation here with some conclusions. So with the max at any level you will consider, you have in fact a trading methodology which is based on sound concept. We explain why these concepts work, and they are always based on the decision and the approach used by the big boys themselves. The big boys are those traders in the big banks who are able to move the market. But what we focus during our training sessions is the following. We use indicator, that's true. We use indicator, but we do not trade the indicator. We trade the price action. An indicator is there, or several indicators are there to help us pinpointing faster two types of situations. Potential opportunity to open a trade and potential risky situations helping us or forcing us to consider how to reduce the risk on the trade. And this is accompanied with, of course, a solid and sound trade risk management and money management. This is also important. If the first aspect here is an important aspect of trading, the second one is important too. And I should add also the understanding of the global context. And so, as you have understood, we focus mainly on the trade risk management. So this is the first priority. The activity of a trader is to assume, is to take risk, but to generate profits from assuming these risks, the trader needs to have a very important trade risk management. And so we focus also about the personal confidence development, because this is related to the psychological aspect. We are not psi, but we consider the trader must get confidence in himself or herself, and we do that through our different activities like the coaching or the mentorship, the homework. Craig will mention more details about our concept of homework, the practice. We have different activities as follow-up activities we have after the course, the workshop, the forum, and what we call the scrolling parties, which are practice sessions we have every Saturday, free of charge, by the way, for those who have followed one course. So here, this is what the max is. I conclude here my presentation. If you have any questions, feel free to post them in the question area, and I give the mic now to Craig for the rest of the presentation. Craig, up to you.
Thank you, Sabio. We do ask you as a MAX student to do the assigned homework. Of course, it's not a strict requirement. It's up to you, but it's very helpful in your progress as a trader if you will do the homework. Eusebio makes an assignment near the end of each class session, and then you have several days or more to complete your homework and get it back to him. And he will evaluate what you have done and allow you to know something about how well you are progressing in learning the MAX methods and concepts. This is extremely important. Again, it's difficult to overemphasize it as it becomes more real to you and not just something that you're sitting in class hearing about. And the suggestions that Eusebio will give to you are individual, they're personalized, and you'll find them to be very helpful. Here's just a quick example of the way the homework will come back to you. Eusebio will take a look at the charts you have made as you have prepared your homework assignments, and then he'll give you specific suggestions and comments about the work that you have done. And I'll be sending this presentation to you, so you'll have opportunity to open the PDF and look at these slides in more detail. And don't let this slide scare you. It can look a little scary, for example, to see that there are over 20 exits provided in the ETF standard course, but we know how to help you learn these and learn them quickly. And once you have learned a particular exit, it can be applied to many situations, and so it's not as scary as it first looks. But again, there's a lot of detail on this slide, and when you get the PDF, you may want to spend some time looking at this more carefully. The courses that you are welcome to enroll in are indeed very detailed, and they're very precise. This training will most likely be unlike anything that you may have experienced before. It takes some time, it takes some effort, but it's very, very worthwhile, and you'll learn how to find a setup and then when to execute it, normally within 1 to 4 pips if you're trading the 5-minute time frame. That will vary a little bit according to the time frame that you prefer, and that's one very nice thing about the max methods. You can apply them in the same manner to any time frame that you prefer. We do train using the MetaTrader platform, and we'll ask you to use that during your training. There are some reasons for this. Primarily, it is no extra cost to the student. You even get the free data feed, as you may know, and we'll provide everything that you need: templates, indicators, practice sessions, and more. You'll get a video of each class session so that you can renew and refresh your understanding of what has been taught. You'll receive the PDF. We'll give you notes and tips to use, show you examples. You'll receive all the information from the chat room. And again, the templates and indicators are no additional charge. Even the upgrade using the ETF indicator and the companion bias indicator, all of that is provided for you. Homework, again, very important. I don't know of any other training service that does it this way. There may be one out there, and if you come across one, I'd like to know about it. But it's a key element of max trading courses. And then the after course follow-up is also very important. You'll be invited to join our private trading forum. There is a lot of extra material in there for you to use as you improve your skills in trading. We provide practice sessions, or I like to call them workshop sessions, and fondly we call them scrolling parties. These are provided on most weekends, but we guarantee a minimum of one every month that applies to the level of max that you have achieved. And there is no additional fee for these. This is just our way of supporting you as a trader as you continue to learn and to improve your skills. We also provide the News Watch list where you can become more aware of upcoming news announcements, and as a part of that, we'll give you a list of the currency pairs that are most likely to be active during that week, and that can help you in your choice of what pairs to trade. So in summary, you get a very solid trading method. You get a lot of support before the course, during the course, after the course, for as long as you choose to remain active in the Max community. And here are the courses and the pricing for the training. Again, all of the courses include the upgraded elements, so you do get the ETF. You do get our profit acceleration techniques. You get the companion bias indicator and training in how to use it. We're very strong on money management and protecting your account, and you will really appreciate the risk management that Eusebio teaches. The ETF standard course begins on Friday, the 13th of April. All 7 sessions of the course will be on Fridays, 7 consecutive weeks. We meet at 4 p.m. New York City time, and you are welcome to attend live. Unfortunately, time zones and work schedules and so forth can be a bit of a problem, so about 40 to 50% of our students are never able to attend the live class session webinars, and so they study entirely by video, and this is no problem at all. We do provide you with a video that's yours to keep of each of the class sessions. Rather than the $2,999 tuition fee, we offer it at a special rate for those who take time to attend our webinar or to watch the video of our webinar. So you can get in for $23.99, and if you need a payment plan, I can provide that. Just contact me and let me know if you need something special. And then we do have a course package available. You can get 3 courses. That's the ETF Primer, the ETF Lite, which is the next step up, and then finishing with the flagship course, the ETF Standard. You can get all 3 of those for $26.79, which is a tremendous savings over taking them individually, one at a time. Many of you will want to consider that. And here's the information on the ETF Primer course. It meets on Mondays, the 16th and the 30th of this month. We give you a little extra time between those class sessions to complete your homework. Again, these classes meet at 4 p.m. Eastern Time, or you can study entirely by video. And rather than the $329 normal tuition rate, if you're a part of this webinar or watching by video, you can get this course for $159, or you can consider our 2-course package, which gives you the primer course and the light course, all complete with ETF training, indicators, everything, $759, which saves you about $300 on those courses. So that's a good possibility for you, and will get you off to a great start with max trading. Some folks just like an opportunity to get to know us a little better, to kick the tires, so to speak, get their feet wet in max trading. And if that's you, then the ETF Primer is a good choice. If you have already built up a good level of confidence in us, or perhaps you have attended one of our live trading sessions, or you plan to attend this Friday as we trade the NFP session, these experiences can give you an opportunity to get to know us, and you may be ready to dive right in to the ETF Standard course. It is our flagship training. 7 weeks of wonderful learning opportunities in max methods, and you will have a very solid foundation as a max trader when you come out of that training. Eusebio, I do have a question. This gentleman is making the comment that it seems like every time he gets ready to enter into a trend, and he relies primarily on the stochastic indicator, he says that most of the time it immediately reverses on him. And is there any remedy for this?
Yes, indeed. This is a good question. So, in fact, this is what you get when you trade indicators. Whatever the indicators you may consider to use, or group of indicators, no indicator is predictable. You cannot predict what the price will do using an indicator. It's not because the stochastic, for example, is making a low that the price will go upward. Perhaps not. So if you base your trading methodology on indicators only, you will get poor result. Craig has mentioned that every weekend we provide, let me show you that, the news watch list. The idea behind a trading opportunity is to try to understand where the opportunities may be. One of the driving factors of the market are the news releases. Unfortunately, not all the news releases are important. If you consider an economical calendar, you will have many news releases, but only a few of them under specific conditions, because the subject is way more complex than many traders can consider. Under some specific conditions, a news release will create a movement in the market. And so every day we provide an updated list for the entire week of the news we consider really important. That news watch list, which can be accessed here on our website www.maxtradingsystem.com/newswatch. It's free. This is updated every Saturday and gives you, only for the news which are marked as major, the news which, in case of a surprise, will move the market. The other news will simply create some possible additional volatility, but they are not dangerous at all. An explanation, a full explanation on how to interpret the information we give there is given below the list. So you can use them. In addition, we give also what are the best moving pairs, because of course we are trend following traders, and so it's better to restrict the trades on pairs which are moving. If you take pairs which are making small average daily range and you want to trade trends with this pair, you will get poor results. So we really need trending pairs, and so we get here what we call our top 10 list pairs, the best moving pairs which can change a little bit week after week. And we provide also every Saturday a list of suggested pairs for each days of the week. You see, for example, today there were too many countries on holiday, so it was a no trading day for us today. Tomorrow we suggest to trade the pound yen, or the pound kiwi, or the pound Aussie, but also the euro yen, and possibly the pound CAD, and so on for each day. We provide them 1 week in advance, and they are based only on these news releases. Of course, we will see movement only if these corresponding news releases are released with a surprise. If they are released with no surprise, we have not to expect big movement. And this is the uncertainty we have in trading. And so understanding where the action may be is important. It's, you know, a market, a pair does not move because an indicator gives a setup. The indicator gives a setup because the market is moving. The reason the market is moving is not in the indicator. It is, at least partially, in all these macroeconomical conditions. There are other conditions, the decision every day by the central bank, the geopoliticals, and so on and so on. There are a lot of factors influencing the market. And by analyzing these factors, I call that understanding the global context, you will see which are the currencies, and so consequently, what are the pairs to privilege in terms of monitoring and then trading. Okay? So this is how I can answer that question, Craig.
Thanks, Eusebio. John has a question. He asks the following. I have very little free time and my job does not allow me to sit at my desk for very long. Can I set up trades in advance with the max method?
No, not really. Not really, and sometimes, I will not say not really always. It depends. If you trade a small time frame, for example, the 5-minute or the 15-minute time frame, I would not suggest to place trades in advance. For traders having time constraint because they have other professional activities, I suggest to use a higher time frame, the 4-hour or even time frames which are built like the 6, the 8, the 12 hours time frame, the daily time frame. And in such a case, yes, with the max, it becomes possible to set a trade in advance because we are seeing forming an entry setup. We have plenty of time to analyze the opportunity to take that trade or not, and we know once a setup is formed, we have plenty of time for that. We know where to place the entry level or the exit level. So it's possible. It's not so easy, but it's possible. So yeah, next question, Craig.
Okay, I just have one more, Eusebio, but again, if you'd like to ask a question, go ahead and pop it in right now and we'll hang around and answer it for you. The question here is, sorry to see this, I have already spent thousands of US dollars without return, and now I have to make sure that my probable last investment in trading will be the right course, will be the right investment. Which course do you recommend?
This is a delicate question. So it is important to invest time and money in education. That's true. The right education and the right investment. And so unfortunately, any trading system does not necessarily fit the objective or the needs of a specific trader or a specific person. For example, if you consider a scalping trading system, and you don't have time to sit in front of your screen and watch the price moving, that system is not for you. Then if you find a trading system for you, you need to spend time enough to really understand how to apply that system correctly. And so the time investment and the money investment are critical element in your education. And for those who want to give a try to the max, I suggest to begin with the max primer. The investment is really minimal, and we wanted to make it really minimum to give a maximum of person the possibility to test us, in fact, and to see if the max is for you. The max is not for everyone. You know, standing inside a trade, holding a trade while the price is unfolding a trend, and during that trend the price is making pullbacks and sometimes deeper pullback, it requires the courage to stay in the trade along the trend. And so perhaps this is psychologically, this is perhaps not for you. But if it is for you, you have a way to test, in fact, if the max is for you. And we give plenty of support to our traders. Whenever they consider a trade, they can always send us a chart to see if they have made the trade correctly or not, to have our comments on the trade, our grading on their on the way they have handled the trade. So this is what I can say about that question, Craig.
Okay, thanks, Eusebio. I think that is the end of our questions. No one has added to the list, so I'll give you the last word.
Okay, so first of all, I would like to thank you very much for your participation, your comments, and your question today. They are important questions. They are usual questions, but important question, of course. Trading is never easy. You have to forget that. For me, it's a wrong concept. Trading must be simple. No, trading is not simple. Trading is complex because you need to understand what moves the market. And it's not a technical setup which moves the market, as I have said. There are more than that. They are all important, but there are more than that. And it's a combination of every aspect which is important. And this is why with the Max we provide several approaches. The courses, of course, our open sessions, of course. The Max price levels we generate every weekend. The news watch list we provide every weekend. The suggested pairs to trade for every day of the week have the aim to help you what we propose, or to help you in your trading process. Let me just show you a last point we have in the Max and ready to the Max price level. So each week we produce for a subset of pairs, so the Max price levels, and I give also a kind of feedback of the ETF trend which can be traded, which could have been traded, in fact, on the previous week. For example, if I take the last week, from the Monday 26 up to the Friday 30 of March, the last day, the Friday, was not tradable because many countries were on holiday, so there were only 4 days, and there were 24 ETF trends pinpointed by our Max ETF concept. Pinpointing these ETF trends, there is no ambiguity. We know exactly when a trend starts and when a trend will end. And you see all these 6 movement, 1, 2, 3, 4, 5, 6, 7, 8 movement for the Monday. I will not count this one because it was during the second part of the US session, which is not a good time to trade a pair like the pound. So 1, 2, 3, 4, 5, 6, 7, 8 for the Monday. And you can see among these movements, we have, of course, small movement like this one, like this one, like this small one here, but we have also that nice one here and that nice one. And we are able to catch them with the ETF concept. And it is these movements which provide the result and which recover very easily the small losses created by small movement like this one. This movement would have created, for example, a small loss. This one would have created a small loss. On the Tuesday, we had 1, 2, 3, 4, 5 movements which were tradable. And look, the tremendous uptrend here. And a small downtrend because there was a news release, that there was a red vertical line here, which was due to a news release, but still a decent movement here. A losing trade, but a small loss here, a decent profit here. So every day, this is, for example, the Wednesday, we have decent trade and sometimes huge trade. Here we had 1, 2, 3, 4, 5, 6, 7. I will not count this one. So 6 tradable movement, and among them one huge movement here. You see? And on the next day, get 2 nice movements, and from time to time smaller movement, and so on and so on. And so, for example, the Friday there was no interesting movement. And at the end of each week, I also sent an example of the trade of the week, just illustrating what the max can do on these trades. And this was the movement, 2 of the movements on the Monday. And for example, here we have the trades which have been made on that down and up movement with 2 trades, and the kind of reward to risk ratio we can have. And we have that week after week after week. So for those who subscribe to this max price level, we have 2 formula, 1 free subscription and 1 paid subscription. Even with the free subscription, I sent these charts, so helping you to see what are these ETF trends and how the price react also to our max price levels. Okay? Well, so they are produced for the entire session. So you have, Ralph, this is the start of the day corresponding to the previous New York close. Okay, here you have the London open, somewhere here you have the US open, and here you have the end of the day. And so you see that depending on the pair, you have also movement you can trade during the US session. The US session starts around this area. There is an overlap with the end of the European session, and so it depends on the pair. Let me give you a small tips here. A pair is always made of 2 currencies. For example, the pound CAD. And so a very quick way to know which sessions are interesting for that pair, the pound CAD, is to consider the sessions related to the currency. So the pound is a European currency, the CAD is an American currency, and so consequently, the European session and the US session are 2 interesting sessions to trade with that pair. If you take a pair like the pound Aussie, the pound Aussie is made of a European currency, the pound, and an Asian currency, the Aussie, or a Pacific currency, the Aussie. So the pound Aussie is interesting to trade during the Asian session and the European session, not during the second half of the US session. The first half, yes, because it overlaps with a portion of the US session. If you restrict your trading to the pairs respecting their natural sessions, you will already improve your result in trading. Okay, because this is due to simply to the presence of traders in this continent. The European traders will have a tendency to privilege the European currencies. The Asian traders will have a tendency to privilege the Asian currencies and the Pacific currencies and so on. Okay? It's simply due to the level of activities in the corresponding currency. But we provide this information so week after week after week, and so we have many movements. When we have such a huge movement, believe me, a movement like this provides a huge result. So we have many of these opportunities every week. So okay, and I will conclude here, Craig, if we have no other questions. So again, thank you very much for your participation. I propose to leave the room open for 5 minutes, 5 more minutes. I will close the room in 5 minutes. In such a way you have time to take note of this information. And you can always contact us here with these information. So our web address, email address, and possibly a Skype address. So, okay. Thank to all of you. Thank Craig, and so see you. We have an open session next Friday for the non-farm payroll. Craig will send to you an invitation to be present, and so if we have movement, you will see how the max applies to this movement. That being said, so thank you again, and in the meantime, take care. Bye everyone.